Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we get started, standard disclaimer, none of this is investing advice. Do your own due diligence. And today we have a returning guest to the program, Mr. David Morgan of the Morgan Report. Thrilled to have you back on the show.
Jesse, thanks. And I listened to your interview recent with Craig Hemke, aka TF Metals, and it was a very good interview. And of course, I've known Craig for quite some time, and he's become pretty well known. I mean, he works with Sprott now and has for years. So touche to you and him as well.
Yeah, it was a great having Craig on, and awesome to have you on as well. And I know last time we dove into silver. I definitely want to focus on silver again today. A lot of things happening. But first, I wanted to get your outlook on the commodities market in general. Is there anything out there besides the precious metals that you're bullish on at the moment or that's catching your eye?
Yes, I'm not quite in the camp of the commodity super cycle, but on a subset, I'm very favorable to the ags, the agricultural, the corn, wheat, oats. Even I think any food stuff is going to over time have up pressure. I mean, you look at the soybean complex, soybeans, soybean oil, soybean meal. There's a lot there, and with the food disruptions for whatever reason, natural or otherwise, there is a lot. So I'm very bullish on the ags generally, metals, of course, not so much on the base metals. And the reason being is I think that we're seeing a contraction in the overall economy, not, a growth spurt. So, but food is a requirement. It's a necessity. It's a must. And if there's less of it and the same demand, the price is going to rise.
So when it comes to the agriculture space, how do you approach it if you're investing, for example? Do you look at ETFs? Do you look at individual companies?
Yeah, I think most
futures?
people are, sorry to interrupt. I think most people are better off on the equity side. I mean, the futures market is like the pros. I mean, I do it occasionally, but that's a market where everything is pretty much stacked against you. Although it's the best way to get exposure to the corn market is to go into the futures. But you can use an ETF. You can also use a proxy like an ADM or a food manufacturer conglomerate. A little safer bet. You're going to get a run, maybe not directly proportional what the move in corn might be, but nonetheless, you will go. So I would say that's probably a best suggestion for most people.
So inflation, obviously the topic of the day. It's been a very real threat to people's purchasing power. When people go to fill up at the tank, go to the grocery store, paying rent, people are feeling the pain. The Fed seems to not have much answers. They just did another 75 basis points hike yesterday. I don't know how much of an effect that's going to have. Do you think inflation will eventually come down? Do you think a lot of it was due to maybe supply shocks and effects of the pandemic, etc.? Or do you see this as a more persistent problem? And what's your view on the recession question? Are we already there? Is this something that might be looming on the horizon?
Well, I think inflation is built in for quite some time. It may come down in terms of what the percentage of inflation is. For example, we might go from the current 9.1 in the US to 7.6 or something along those lines, but it's not going to be at 2%. And as far as the recession, there's absolutely no doubt that we're really in a recession right now. My take is that it's going to become worse than recession. It'll become a depression. And of course, no one wants that. And the Fed will do whatever it can, at least that's what they've always done in recent history, to stave it off. But you can't print yourself out of this mess. And that's all they have really as an option, is to print fast or print slow, but just keep printing. So right now it's the print slow or tightening up and increase interest rates. The only way that in my lifetime and others, if you go back in monetary history, where you really quelch the problem was to put the debt markets into a format where you were making money. In other words, to get the real interest rate above the inflation rate. That'd require a minimum of a 10% yield on the bond. And I don't think that the ability for the Fed to, one, have that kind of stomach to go that high, or would the market even take it? Because the interest payment on the national debt would explode with an increase in interest rates like that. So I think they're stuck. I think they're going to continue to jawbone it and talk and maybe make a few more rate increases. But in the longer term, I think pretty safe that, as the late, great Richard Russell used to say, they have to print or die.
Yeah, so if it all hits the fan and people are waking up and realizing this situation, the economy's not just going to suddenly get better. We're looking at persistent inflation much higher than the Fed's 2% target, even if it does go down a little bit from where it is now. Are we going to start to see more of an institutional investment in gold and silver? And the reason I touch on that specifically is because, I had Jeff Clark on the show recently, and he was saying that he thinks by the time your average person wakes up to this and realizes the value in precious metals, that it's probably going to be too late for those people. But at least at the institutional level, theoretically you have some smart people who are watching the markets. Do you think we're going to see a shift maybe away from bonds and other supposed safe haven assets on an institutional level and into gold and silver?
Well, that's an excellent question. And first of all, it happened in silver in 2020. In 2020, there was, I think it was 320 million ounces of silver purchased by the ETFs, and another 200 million purchased by retail, which is like 520 million. Total silver market's 1 billion. So over 50% of the market went into investment in 2020, and the price went from roughly 18 to 28. And so somebody was in there on the institutional side buying. That changed in 2021, but that's when the Wall Street silver crowd started in. So first of all, the big money institutions will run to gold. I'm almost certain of that. Will there be some spillover to silver? And the answer is yes. But, Jeff and I are, fairly close. And, I think he makes a good point that, you might just see, first of all, for silver, it's almost a ho-hum for most institutions of size. I mean, the problem with silver is you get too much for your money. I mean, if silver was priced relatively to what its utility is, or what its fair value would be relative to, it would be a different scenario. But it's really hard to get a monetary, let's say, life preserver with silver. If you're at the institutional level, you're much more likely to go to gold, because the amount of silver you would need would be significant, and there's not that much available. I'm not saying there wouldn't be some pension funds and some smaller family offices and some well-heeled private investors that aren't going to run to silver. It's a far superior investment to gold for many reasons. But see, I would tend to agree with Jeff on that. And I just want to go one more step, Jesse, with you. And this is what's so interesting about the silver market, is when everything does hit the proverbial fan, the meek shall inherit, the buying power. I mean, it's those silver stackers out there in Wonderland, that's reality, that they will have some mechanism to exchange real something for real something else. And the banks really can't do it. So I think you'll see it move to gold much more than you would to silver on the institutional side. Some will spill over, but this doesn't diminish where silver will go, because there'll be such a run to gold that the amount of retail that comes into the silver market could go really, really strong. And as Mike Maloney has said, often it becomes unobtainium. I mean, that certainly is a possibility. Most just poo-poo that whole idea, but we haven't had a global financial crisis this epic ever. We're into new territories. It's just what's that one point where everybody wakes up? And of course, what I mean by everybody's like 1% more than we already have. All it takes is a doubling of what we already have for precious metals demand to take the market much, much higher.
So I don't like talking too much about short-term price movements. We've seen today as we speak, I think silver's up 6% or something like that, and gold has seen a little bit of a jump as well. But overall, people have been underwhelmed by the performance of gold and silver, especially in the face of this inflation, etc. A lot of people don't have patience as well. But I'm just wondering, is this perceived underperformance? Is this due to a broader market correction? People are just selling whatever they can. Is it due to manipulation? Is it a combination? What's your thesis on it?
Well, it's a combination, and it's really fairly normal market activity. So I somewhat contradicted myself. The idea is that it's instantaneous, and it's not. There's a lag. So as the market works through what's really going on, what's the Fed really going to do? What's really going on in the physical economy? Are the financial markets really aligned with what's happening in the physical economy? All those type of factors take some time to work through. Once it's understood, then you're going to see the metals perform. And I am fairly happy with my analysis that I put out for the last 3 or 4 months. And I said, if you look at the 2008 crisis and you saw how badly silver and gold got walloped, along with everything else, gold got walloped less than a lot of other um, financial instruments like stocks and bonds. But nonetheless, it got a 30% move to the downside. They were the first to recover. This time, the sell-off in gold and silver were far less percentage-wise than they were in 2008, which led me to conclude, hopefully logically or somewhat logically, that this means that the market is anticipating a bigger bang for a downside crisis than we had in 2008. That's exactly the way I see it. And I think they're ready to spring back. I don't know if, from tomorrow onward, but I'd say by the end of the year, it's almost a certainty. And so, in my view, they're really performing as I would expect them to. But I've been in this market for over 40 years. And I know that the idea is, stocks down, metals up. But again, it's not on a daily trade. It's not a daily basis. And usually, actually, going back in history, a lot of times when it was like gold has to go up on this bombing or on the kidnapping or all these things that happen in the geopolitical sphere, and it didn't. And I remember talking to one of the major bankers in Europe about that, and basically indicated that that's not how the market works.
So here we are again with another high-profile criminal case against former JP Morgan employees coming out in the public. And, there's 3 people in particular named in a criminal conspiracy to manipulate the gold and silver markets. I think we both believe it's much more than a small handful of people. But this is it's happening again and again. Is this just something that's going to keep getting swept under the rug? Is there going to come a point where regulators do their jobs and actually step in and take major action to stop, instead of just fines, to actually come in and change the system so that this can't happen anymore? Or is that just hopes and dreams?
Well, the real answer is I don't know. I think it's probably hopes and dreams. I mean, it really galls me that, what the Hunt brothers did, right or wrong, the outcome was they could never trade silver for the rest of their lives. But then when you have Morgan Stanley that gets caught point blank buying silver that they never bought. In other words, clients came in and bought silver and stored it with Morgan Stanley. After the case was opened, it was determined they never bought an ounce of silver, didn't even have a vault. And then during the discovery phase, they more or less indicated that it was standard practice in the industry to sell silver only on paper and not vault it and charge accordingly, that as if it were. And what did they get? They got a fine, and they also didn't have to say they were wrong. They didn't admit wrongdoing, they paid a fine. Well, what's good for the goose is good for the gander. I mean, they should be taken out of trading silver for the rest of, maybe a corporation doesn't die, but maybe 10 years or 5 years or at least 6 months or, something substantive, rather than, well, let's see, you made $1 billion, give us 100 million and keep going. And that's unfortunately what we've seen, more or less. My numbers are just there to indicate the idea, but these fines are relatively small compared to what they're grossing out on these silver moves. I wrote a chapter in the Silver Manifesto, and I go through a couple of examples of why this is a manipulated market. Is it manipulated every day, every tick, every time? No. My belief, and has been for a long time, although I've come into the question it once in a while, and that is that the major trend can't be manipulated, but within that trend, it certainly can. And the main trend for gold has been up, and the main trend for silver has been up. Um, Not substantive, not what we expect, not what would be in line with the amount of inflation or the paper money printing or the lies that go on throughout the financial system. But nonetheless, silver was under $5 in '99, and it's at 19 now, and gold, bottomed in 2000 at 252, and it's 1750 now. So, but again, I think they have much more room to go, especially as this end game continues, because there's not a lot left until we get to the end.
So let's shift gears to investing. And we spoke at length last time about bullion, silver and gold bullion. So I wanted to get more into mining stocks now, and specifically touching on silver miners, because a lot of people think they're very undervalued at the moment. When you're investing in a silver mining company, how do you evaluate it? What are some of the criteria you look for?
Well, again, just and I'm not a book salesman. I don't make a dime on these books, but in the Silver Manifesto, there's a chapter on how we pick a mining company. So if anyone's really interested, they should actually, you know, get a copy of it and read it, study it, and learn. But generally, we just did an update about 3 months ago for our paid subscribers, our premium service, and we outlined why the royalty model or streaming model is much, much superior to just buying an outright mine. Not that we don't have some miners in the model portfolio, but we stick with big money and big companies. So, for example, Pan American Silver, his mandate when Ross started the company was to become the world's major primary silver producer. It's pretty much filled that mandate. And we bought it at 250, and now it's substantially higher than that. I mean, the dividend I get from a 250 stock is around 10%, because even though it's still 1% relative to what the current price is, the price has gone up so far. So that's investing. That's the kind of thing you want to do. As far as, it's really more timing than anything in the silver market. I mean, if I would have just stopped at 2011 when it called the top and just gone into like the FANG stocks for the next 10 years and just now come back into silver, I'd probably be known as, a big hero, right? But I'm so bent toward honest money, sound money, relationships between, the financial markets and the economy and all the things that I look at and talk about and write about. So as the gold boom, run to gold becomes more prominent, then anything with gold and silver will move. And the thing about the stocks is many people that have a Ameritrade, Scottrade, E-Trade, you name it, an electronic platform, they might only have, modest amount of money in there, but they'll feel like they've missed out on the gold move. Gold's gone from 1750 up to 2750. What happened? Geez, I remember it was under 2000. I was going to buy some then. But they'll look for cheap stocks. They'll look for the cheapest stock they can find that has gold in the name, or the cheapest stock they can find that has silver in the name. And those things will fly. I mean, if you play it right, I'm thinking about doing it. I'm not sure I want to, but I own the domain Silver Speculator. And I was thinking about writing a program where I would just show you what the movers of the day are. And I mean, the disclaimer would have letters that big, because it's a fool's errand in a way, because you're betting only on the name. And but there'll be a run to silver and gold, if I'm right, that will pale in comparison to what happened in 1980. And a lot of those stocks in 1980 just doubled, redoubled, and doubled again within a matter of a couple of months. So you can play catch up if all you want's fiat by buying the juniors, but you got to buy them at the right time.
Yeah, I like that idea of royalty and streaming, just to de-risk so much of it, right? You're not if
Yeah,
one.
well, we had one of our members, they get to ask us questions. Everyone gets to ask one question a month, and I promise to answer every one of them. It's not necessarily me, although most of the time it is me or one of the staff. And he asked, or she, I forget, with all these costs going up for oil, and oil being so important to mine operations, and what do we do? Are we smart to be in the miner still? And of course, the short answer is No. I mean, the smart answer is look at what the best return is, and that's on the streamers and the royalty companies. Of course, as I said earlier, we do have some flat out miners, but and then you got to look at the geopolitical risk. There's a lot to it. I don't want to make it too complex, but you don't want one mine in a jurisdiction that has a problem, and then expect that that problem won't affect you because Venezuela had one of the best gold discovery, one of the best gold mines ever, but it had a big black cloud around it legally, and I never touched it. Some of the others in the industry were touting it strongly. Well, anyone that put their money into that company, even though it had the gold, it was in fact extremely rich, lost money. So you got to be real careful in investing in general, and miners are probably one of the tougher places to put money as far as volatility and as far as expectations.
Right, and I did want to touch on jurisdictional risk a little bit since you brought it up. Are you really, you just stick to jurisdictions that are considered quote unquote safe in terms of there's not going to be a war breaking out? The political system is at least somewhat stable, although there's less and less places in the world right now where that's the case. Because, of course, in more supposedly stable jurisdictions like Canada, where I'm from, you get a lot of ESG mandates, you get a lot of red tape, and permitting can take decades, right? So do you look at that as its own jurisdictional risk, and do you weigh that against a place like somewhere in Africa where, I invest in uranium mainly, so, a place like Niger, which has a strong uranium mining district, but some people would have concerns that, well, it's Niger, sometimes wars happen, terrorism, not a safe country. How do you balance that risk?
Yeah, it's balanced. I mean, we certainly look at it very carefully. And for a quick example, well, back in the 70s, since I went through that bull market up to 1980, most of what I held were South African miners. And now I've never owned this cycle. I haven't owned a single South African miner, with the exception of one. That was a special case, and I did it on a trading basis. I did it, okay, this is not an investment. This is a short-term, medium-term trade. So nothing against the South Africans, it's just the political stability. And, to get any exposure to platinum or palladium, platinum especially, you pretty much have to invest on the equity side. You have to invest in South Africa. You can't invest in palladium in the the old Stillwater mine. I forget the new name. I can't pronounce it, but the one in Montana, it's a couple states over. But I will take exceptions, but generally speaking, there are jurisdictions I just won't do it. I was involved with a coal project in Mongolia, and I mean, this thing lined up so perfect. It's like, I mean, how does it get easier than this? And it turned into a mess. So you just never know.
Right, it pays to do due diligence. And what do you think about, like, obviously with a royalty company, you can also get geographical diversification, but in an individual, let's say somebody wants to go ahead and take the time, do the due diligence, learn everything they need to learn about geology and everything they need to know about analyzing a deposit. Do you think it's important for a person who's investing in individual mining companies to be geographically diversified? So maybe have something in Canada, something in the US, places considered more stable, and then you can kind
Exactly.
of take a little more risk.
Yeah, exactly. And I try to keep it simple. For example, in the top tier, I suggest people take, I think there's 6 or 7 in there, take like 3, and I'll name them, or which 3 are performing well at a particular time. But when you get out like a Pan American, you're getting, mines all over the world, basically. So you've mitigated your risk quite a bit. And that's what you strive to do. I mean, the idea of buying, one mine in one country might outproduce. And, one thing I've done, Jesse, and I haven't said this in public, I don't think ever, not that it's a big, profound thing, but I have gotten, calls or emails or communications over the years, and, investor X or investor Y wants to, subscribe to the Morgan Report. And after doing a conversation with them, I usually tell them to buy a mutual fund. You don't need the Morgan Report. Now, I usually beat most of the guys that are in the gold mutual fund business. if and only if you follow the directions I spell out and how to use the Morgan report. I mean, if you think you can outsmart me, go ahead, because I'm not perfect. And I've always said the market knows more than I do, but I'm pretty good at the market. But, if you don't weight the portfolio the way that I weight it, and you see that little speculation down there, and it's got the same symbol as your wife's mother-in-law, and you decide that that's a sign that you're going to make more money than God, and you put all your money into that, and it blows up, that's not my fault. Because on those, I say bet money you can afford to lose. So if you bet the farm, you're not following the direction. So I'm not trying to be going a tirade here, but a lot of people over the years, I actually got a kind of a compliment from one of the better known managers for a gold fund, and he knows that I've sent him a lot of business because it's just easier for a lot of people. They want exposure. You're going to get, that one little stock that goes up 40 times. Probably not. You might get it because it's in the mix of the mutual fund, but you're not going to get the juice that you get if you owned it individually. So, but I think it's important for people to know that. I mean, look, I'm here to help as much as I possibly can. What I do is just very niche market. And of course, my macro views, I think, are, counterintuitive to the mainstream, obviously. But I'd say on balance, my head and heart have been in the same place the whole time. And it's been to be of maximum service to others during these very trying times on the monetary sphere. And of course, that touches basically everything.
Yeah, well, thank you so much. You've been of great assistance during this interview. I'm sure people are going to find a ton of value from it. You were speaking a bit about the Morgan report before. For those of our viewers who aren't familiar, could you explain what that is and also where people can find you online?
Yeah, I just put up a new landing page. So it talks about sound money. So just go to themorganreport.com. It's a long sales page, I admit it. But in that, embedded in it, is an interview I did with Stansberry Research. It's got over 2 million views, and it talks about the bail-in possibility in the United States. Any investor that has any money of substance in the bank, which means if you've got more than 25 bucks in there, I'm being facetious, you should listen to that video, and it's free. But it's imperative that you understand what the financial powers that be have in store for you in the not too distant future. It is illegal to bail out a bank now. The only way that a bailout happens is with a bail-in, meaning they're going to take your money as an unsecured depositor with that bank and take care of the problem, money problem. And you will become a shareholder in said bank. So be careful, people. There's going to be, I would say, Jesse, if we're still here and the internet's still on, 3 years from now, we'll be having a much different conversation about what the monetary sphere looks like.
Well, I can't wait for that day, and I do hope to have you on again before 3 years passes. But at that time, I definitely want to chat again. So thanks so much, and hope to have you on once again.
Thank you. It's a pleasure.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.